Kallina. First of all, I would like to refer to Martin Stopford's comment about bankers buying new cars. I would like to state for the record I drive a 6-year-old small Mercedes and there is no change intended. I'm thankful that I maybe have the easiest topic today to discuss, which is banking ship finance. Why is it the easiest? Let's have a look. If you go to your shipping banker into his office, you will very likely find out that the bank is open for finance, always was. There are some issues for the competition, regulatory, and especially the German banks have some non-performing stuff. And if you then ask a banker, what kind of... Yeah, okay. And if you... Yeah, thanks. And if you ask your shipping banker what kind of clients he's looking for, you get the answer, he's looking for solid counterparts, for quality operators, and for sound structures. And you will leave the office of your shipping banker and say, hey, great, that's me. He was just describing my business model, and he was just describing my attitude towards shipping. So you might come to the conclusion, there are two ways, the passive approach, and you say, well, I don't need to do anything. I just sit and wait and see when the banks have sorted out their issues, and then I can join or enjoy the banking market. Or you even set up a holding structure, and then, hey, the capital markets and the banking markets are there for you right now. So it sounds a little bit like going back to the good old days of 2008 and before, isn't it? So if you look 10 years back in February 2008, ship finance was on vogue. It was dominated by Western banks who pretty much kept to themselves. Non-recourse financing was no issue. So you could easily get a loan tenors 8 years, 10 years, 12 years. And banks were fully happy that they could give you a loan, and there was not so much discussion about cross-selling. If you go to a shipping bank now, ship finance within the banks has lost a lot of its sexiness. It's a bigger variety of players geographically and also from the different groups of capital providers. Non-recourse finance is not so interesting anymore for banks. Loan tenors are more in the region of 5 years, and before your banker answers you the question, if you get a loan, he answers you what else you have to offer for him. So the big change is that 10 years ago, there was a very similar understanding among the ship finance providers what ship finance is. So to some extent, ship finance was a commodity, and the scope was big is beautiful. Now, if you ask 10 banks how you define ship finance, you get 11 different answers. And not big is beautiful anymore. The new tenor is smart is beautiful. So let's have a look how smart ship finance looks like. So if you are a ship owner enjoying active lending relationships with various banks, I have good news for you. You can influence the lending decision of your bank. And this you see on the right-hand side: company structure, loan structure, cross-selling, pricing, green aspects, or things which you can discuss. The problem is that there are several strategic factors a bank takes into consideration before you even reach that second level. And this is capital allocation, which Professor Dorbeth just mentioned. The decision, are you a core client, are you a non-core client, exit, internal setup. Is ship finance still within the bank an own department, or are you reporting suddenly to a head of transport or a head of whatever? Mergers, portfolio management, rating migration, the redefinition of ship finance, and one of the most important things is regulation, because this has an effect on many of the other things I just mentioned. And on all these factors on the left-hand side, you have no influence. You just have to wait what your bank is deciding. So let's have a closer look at some of the buzzwords of regulation. So the first one, which is very prominently mentioned always, are the 2017 amendments of the Basel III Accord, or as they are widely dubbed, Basel IV. Basel IV is a rather complex mix of modifications, how you evaluate risk, how you assess risk. And I think the two most important things to mention here are that the use of internal rating models within banks will be limited by Basel IV. And the so-called global systemically important banks have to accept a surcharge on their leverage ratio, which means they are limited even more in their lending capacity than regular commercial banks. So what are the implications or the potential implications for ship owners? I mean, one is that you have to expect shorter loan tenors. Maybe banks go more into bridge financing. The focus is more on cash flow. Internally, you might see higher return requirements. And what is important, mentioning the globally systemically important banks, I think there is a list of about 40 players, and half of those players are engaged in ship finance. And another thing is, what I hear very often recently is that people say, inside banks and outside banks, hey, 27, this is 9 years down the road, so this is a long time, I don't need to care about this now. Ladies and gentlemen, the critical date is 22, because in 22, compliance with Basel IV starts. And then the hurdles are increasing step by step until the banks have to be fully compliant with Basel IV in 27. And if you go to your bank now and you get a 5-year loan, the loan runs until 23. It means you are already in the world of Basel IV in the last 2 years of your loan. So don't get tricked by the deadline 27. Banks will work on compliance much earlier than this. But if you like something which is not so far away, you can look at IFRS 9. IFRS 9 is already here. It started to be effective on the 1st of January 2018. The major point here is that banks need to decide at the beginning of giving a loan what they want to do with it. Do they want to keep it on their books until the very end? Or would they like to have the possibility to sell it? If they opt for the second, then the loan sees a fair value treatment from day one. And this is what banks usually don't like so much. The second important thing is that IFRS 9 could have implications on banks providing non-recourse financing. I say could have because the language of the regulation is rather unclear, and especially when it comes to ship finance. So different banks could have different interpretation of the standards and legally possible interpretations of the standards. Where one bank says, well, if I consider this and that, it has no effect at all on me providing non-recourse finance. And another bank might say, okay, my view is different. It has effects on providing non-recourse finance. Which brings me again to potential implications for ship owners. Find out, is your bank accounting under IFRS? So only then the bank has to be compliant with IFRS 9. If the bank in Germany are accounting under HGB or under the Greek standards, it doesn't matter for this bank. Try to find out if your bank sees any change in providing non-recourse financing because of IFRS 9. And another implications will be like I mentioned for Basel IV. You will see a stronger focus on cash flows, tendentially shorter loan tenors, and watch out. Fair value is not the same as market value. Fair value is calculated as discounted cash flows based on a scenario, various macroeconomic scenarios. Well, we stay with IFRS 16, I think this is known to most of you because it impacts ship owners much more than it impacts banks. Practically, it says that you have to consolidate financial and operating leases and long-term charters on your balance sheet. Practically, this leads to an expansion of ship owners' balance sheets, and in particular, it leads to an increase of the leverage ratio of projects and companies. The most important thing here is, if you are not trading vessels on the spot market, if you are engaged in leasing, if you are engaged in longer-term charters, and then have a very, very careful look at the language of your loan covenants. Because there, if you have covenants dealing with equity ratios, covenants dealing with leverage ratios, it could be that the introduction of IFRS 16 next year brings you over the threshold. And don't take it lightheartedly. If you go to a banker and says, I just have a breach because of a regulatory change, a breach is a breach. And especially if you have cross-default language in your other financing agreements, this could really be an issue. So try to get an understanding, if you haven't done it yet, what IFRS 16 means for your loan covenants. And if you are in doubt, speak to your lawyers who were documenting the loan agreement, and speak to your bankers. Last but not least, I call this the big unknown. The ECB has introduced last October 2017, the so-called non-performing loan guidelines. They were planned to be effective on the 1st January of 2018, and it met heavy resistance from governments and regulatory bodies within the member states. The question is not so much, will this come at all? The question is for me only when it will come into effect, still in 2018 or 2019. And the big change here is that the ECB requires a much stricter risk provisioning policy than you've seen it before. So for unsecured amounts, the banks have 2 years' time for a full provisioning of the loan. For a secured amount, it's 7 years. And we're talking here about secured amounts, not secured loans. So if you have a secured loan and you are having a loan-to-value issue, it might be that you are very quickly entering these unsecured amounts. And if you look at the unsecured amounts, you have 2 years' time for risk provisioning. It means 50% of the unsecured amount the banks have to take as risk provision, linear, each year. For secured amounts, it's 7 years. Sounds a long time, but in the worst case, even on a non-performing secured loan, a bank has to take 14% risk provisioning of this loan each year, because the regulator says, well, if you have not used the collateral after 7 years, it's worthless. So this will bring probably some dynamics into trading loans, especially for non-performing situations, and this will make restructurings much more complex, because you have then, after the possible introduction of those guidelines, you have loans which fall under the new regime, and you have loans which fall under the old regime. So this makes it very, very complex to enter into restructurings. And also, I think the willingness of banks entering or granting waivers will be limited in the future more than it's already now. Some further considerations, and in view of timing, I would like to stress 2 things from this page. I very often see that ship owners think that an improving market will bring the banks back, big style, on the table. The improving market is very much welcome and it's very helpful, but it's not, as I showed you earlier, the deciding factor for a bank whether it enters or re-enters ship finance or not. Then there is a big discussion, or one of the buzzwords is corporate structure. Same here. If you ask 10 banks, what is a corporate structure for you, you get 11 different answers. For one bank, it could be enough that you create a holding company, an empty holding company above your SPVs. This could be enough for one lender. The other lender might tell you, well, a corporate, this is a company with a turnover of at least $300 million US. So ask your banker how he defines a corporate. Concluding remarks, very important. Don't put all your eggs in one basket. Keep your options open. I think you, especially here in Greece, have made the experience that you have seen the retreat of Commerzbank, Schiffsbank, and Royal Bank of Scotland, which came more or less unexpected in both cases. And both did not exit the market because they made so bad experiences here in Greece. They made the decision because of other strategic reasons. So keep your options open. Establish dialogue with several capital providers. You can start today. You have people from Chinese leasing companies here. And start the dialogue when you don't need the money. Because especially in Asia, but also with new banks, you need time to establish a relationship. You need time to understand each other. Get an understanding how your banks assess risk. And if you have the possibility, speak to the risk manager of your loan, because he is the one who has to put all the information into the system. And if you can provide him with a good understanding of your company, and you can enter into a dialogue with him where he has the possibility, or she, to answer questions, it's very, very helpful. But not all risk managers are open to that. When you go to a bank and talk about a new loan, even if we have historically low asset values, do not speak when you ask for a new loan about asset values, because speaking about asset values means you are indirectly speaking about the realization of collateral. And this is not something which credit committees want to hear these days. Speak about the cash flows. Yeah, I see my tea is ready, so read your financings agreements very carefully. And here also in doubt, they mean what they say, especially with the providers of alternative capital. If you think that an organizational restructuring will benefit your company to get financing in the market, then it might be good to go for advice. Go for an advisor. I think we have a few of them here. One is the organizer of the conference, because one change might benefit or might bring you benefits with one lender, but the same change might not be beneficial for another lender. So you need to define with whom you would like to bank and what is your future financing market. And mind the gap. Very, very important. It's not only important to get financing from several capital providers, but you also need to coordinate and to manage during the lifetime of your financings these different capital provider groups. And this is a very challenging task, and if you do this occasionally, then also you can go for advice. And if you have regular financing requirements, you might considering to recruiting a professional into your company. Thank you very much for your attention. And yeah, Efharisto.